People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, as always, zinniawealth.com. If it's time to talk about your retirement, let's get that conversation going. Don't put it off anymore. Let's do the math on your retirement. We'll talk a lot about that today. Charisse is here. How are you doing today?
I am doing great. How are you doing, Randy?
I am good. I understand you have a new nickname. It's Rambo Reese is your new nickname here. We'll get you all camoed up, and you've been out there paintballing? What's going on here?
Yeah, so my daughter and my son, we went paintballing over the weekend, last weekend, and we had about 10 of their friends come with us. They're all about 16, 17. Most of them are 17 years old. And I'm going to tell you, it lit a fire under me because you got a gun and you have a mask. And all you're doing is crawling in dirt, hiding in bunkers, in trees. I felt like I was in my 20s. And luckily, I'm super healthy right now. And I could keep up with these kids. But I'm going to tell you, I did not get hit the whole entire day.
Wow.
And I was knocking kids out like crazy. And it's terrible I'm saying that. I was at my most high competitive level you could catch me at. And there was no grace given to these children. Poor kids. They're probably talking to their parents like, there's something wrong with Miss Rivers. Like, she scared me. But I'm going to tell you, it was at Wayne's World here in Ocala. And I'm going to start going back because there's something about that competition, that level of the sweat. You're wearing two outfits just so you don't get bruised because it's pretty painful.
Yeah.
And at the very end, there was a duel, actually, because my daughter and I were on two different teams against each other. It was the very last one. And boy, that's when I did this front flip, rolled, found another bunker, and leaned over and tried to shoot her. Thought I got her, stuck my head out. She got the top of my head, like just flicked it. Thank God, because it was a little sore. But it was so much fun. But, when I was in college, I did a little paintballing competitions. I mean, this is years ago. And there was always doctors and lawyers at these competitions. And now I get it. I'm like, yeah, you just got to blow some steam off. But, poor kids. Like, I did not get any kids in the throat or the head. It'd be like in the shoulder or the arm or leg. But these kids probably went back to those parents. Those parents are never going to allow them to hang out with Miss Rivers again, because we had two kids that got hit in the throat and then one right in the forehead. The mask came down. It was bad. But anyways, it was fun. And I'm nearly 50, and I felt like I was 20, and I think I'm going to get back out there.
I think, I don't know if that's just for the kids or for the parents, because teenagers are a little frustrating when you're a parent, and to go out there and just pummel them with paintballs, that's just got to feel good at a certain point.
Yeah. And, Eli was the small guy in there on that team, and he wasn't even on my team. He should have been on my team, but he wasn't on my team. He was the small guy. And he won one of the challenges, which was amazing to me. He turned into this little sniper. He followed some directions, and then he snuck up. I was like, good job, buddy. So you just don't underestimate the little guy on the team.
There you go. I love it. You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, as always, zinniawealth.com. So we talked through some of the issues of retirement, and this is one of them. You save your whole life. You put money in a 401k, and you put money in all these different places, and you save so that you can spend some money in retirement, have some fun. But then as you get to retirement, here's what you read. Oh, watch your income, because your Social Security could get taxed. Watch out. Your income could be too high and your Medicare premiums could go up. You take money out of that 401k, there's capital gains. Or, you get to RMD age and you're going to get hammered with taxes. And then you wonder, did I do the right thing? Did I save for nothing here? So, Charisse, some of these things are
Nothing's free. Nothing's free.
Well,
Randy.
yeah, I get it. But some of these things might be a big deal. Some of them might not be. And, don't sweat the small stuff. Is some of this not something to be worried about here, Charisse? What should we worry about and what should we not worry about here?
Right. So I always say don't sweat the small stuff, but know the small stuff.
Okay.
Because if you don't know it before you go into it, then you're sweating it. And then you're just mad. You're like, I didn't know about this. I didn't know about this. And this is why life is always a journey, and how you navigate it matters, and who you go through it also matters. And in retirement, you want to go through retirement with somebody who's going to show you some hot spots that are going to take place if you take too much money out of your 401k. Because if you take too much money out of your 401k and you have income coming in from other sources, your Medicare Part B premium could go from $185 a month to $280 a month, all the way to $650 a month. So if you know the game ahead of time, there won't be any surprises. And if there's another strategy so that maybe we don't have to pull all those dollars out of the 401k because maybe you need some extra cash flow for whatever reason, maybe there's other monies in a brokerage account or a Roth that could keep that extra fee away when it comes to those IRMAA rules and Medicare. And then think about Social Security. A lot of people don't know that there's something called a provisional income formula, that when your income's at a certain level, you're going to have to pay taxes up to 85% on your Social Security. And people are like, I got to pay on my way out. I paid through my FICA taxes my entire life. And so we have to talk about that, like how much of your Social Security is going to be taxable, because it's always a little bit of a surprise. And the other part of that is, do you take Social Security early at 62? Do you wait to 67, full retirement age, or you take it at 70? Because if you delay, you get more, right? But if you are considering some tax strategies, like one simple one, rolling IRAs over to a Roth, you don't want to have that double taxation because you're taking Social Security and rolling them over. So sometimes you just wait to roll it over. And as long as you live to 80, you're at a break-even point with Social Security if you take it, whether it's 62 or 70. So there's just rules, right? And we follow them. And then sometimes we have to break them because we just need the money. I think a lot of people who come in and see us, they've never even heard of an IRMAA rule. They've sold a house and they're just like, yeah, I got hit with this silly IRMAA rule and my Medicare Part B premium went up to $650. And so because their advisors don't understand it, most advisors don't go through the entire retirement puzzle, right? There's 5 parts and most advisors only focus on the one. They focus on the investment plan, which is important too, but we focus on the healthcare plan, the tax plan, the estate plan, the income plan, which is the most critical foundation. So that is what makes us different, especially as fiduciaries, because not even all fiduciaries are created equal. I mean, if you went to Fisher Investment and then you talked to them about taxes or Medicare, they'd be deer in the headlights and like, hit the road, Jack, right? And so all these things are really critical when it comes to retirement and penalties. And let's talk about the RMDs, Randy, your required minimum distributions. If you don't take it when you're supposed to take those dollars, you get another penalty. And so we don't want to run up against this gamut of not knowing. And this is why you want to work with a retirement planner who actually understands wealth management and all the tax rules and the government rules that could affect you, so you can keep every dollar in your pocket.
So when you get to retirement, you start to see some of these limitations and some of these penalties and some of these things that happen. And you say to yourself, wow, if I want to have a nice retirement, I'm going to go over this number on Social Security. Well, maybe that's not the one that you really have to worry about. Maybe when you get to 73 or 75, when you start taking those RMDs and it puts you in another tax bracket, that's the one to really worry about. So let's sit down and figure out, kind of look down that telescope. And we're going to talk about that a little bit today, of looking far down the line, 10, 20 years from now, what's going to happen to me and my money. That is part of the retirement planning process, looking what's happening now and what's happening later and having a plan for all of it. Here's the number and here's the website for Charisse Rivers. It is ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box on the website there, whether you're on your phone or you're on your computer, you're on your tablet. Just look for that gold box that says Complimentary Retirement Consultation. And when you click on that, you'll be able to make your appointment right there. Or you can give us a call. It's 833-368-3680. Again, 833-368-3680. Well, you don't even have to look at the political news to know that everybody's talking about how much it costs to live these days. The cost of living, affordability is a big word right now. And, you know, if you live in Florida, it is really an issue. I couldn't believe this when I read this. They were talking about the cost of living in Florida. And right now, if you live in Miami or Fort Lauderdale or Palm Beach. The cost of living there is roughly 5% higher than New York. Wow.
That's not surprising.
That is nuts. So people in our area, Charisse, are getting hit with rising HOA fees. They're getting utility bills that are higher than they've ever had before. Certainly, there's the price of gas and price of groceries, community assessments, all this stuff. People are moving down to Florida to retire, and the price is just continuing to go up. Have you had people come to you who you've worked with for a little while? They have a retirement plan, and then they get to be 71, 72, 73. They're into their retirement, and they come back and they go, Charisse, it is more expensive to live than what I thought. I need more money. So first, is that happening? And number two, what do you do about it? How do you approach that one?
Well, actually, I get it earlier in life. When people turn about 73 to 75, they actually are pulling back the reins, not traveling as much.
Okay.
So they don't actually need as much income outlay as we originally put together, which is normal. But it is earlier in retirement. It seems like about 3 to 5 years after retirement, they're like, hey, the costs have come up. I know we built in the income plan and inflation adjustable income, and we're getting more income every year. But now we have bought this house at the beach, or maybe Miami or Fort Lauderdale, because the costs are astronomical down there. Like, to have something down there is insane to me. I actually just had a client buy a place down there. Believe it or not, I couldn't even believe it. But they swore that it was going to be great Airbnb. Airbnb, and they were going to make a lot of money. So we had to shell out some money for that house as well for them. But most of our clients aren't really asking because they're automatically getting higher increases in income.
Okay.
Because of the nature of how we build out income plans and how our inflation adjustable income goes up every year to sometimes every couple of years. So it's kind of already built in, because we know inflation is going to hit people. We know the iPhones are going to cost more money. We know they're going to want to keep up with the Benjamins, and these things come up. So it's built in naturally. And some people don't even actually get more income because we're front loading it so much that it's actually more than they're asking for. So sometimes we'll wait for that inflation plan to kick in. And so it just depends on the plan. It depends on the person. It depends if we know they're going to buy a place on the beach or an Airbnb to get extra income so that they can also travel there. And I would say very few people are in that position. But I will tell you this much. We get so many people from Fort Lauderdale, Miami, West Palm moving to North and Central Florida because it is so much more cost effective to live up here, because those billionaires are pushing out the millionaires down there. And it's just getting very heavy in traffic. And so there's been a lot of changes over the years, but it keeps the prices keep going up. And a lot of people are leaving New York and they move to Florida and South Florida, and hence, hey, supply and demand, why the cost of living is so more expensive there than New York, because so many people don't want to be in New York now, especially after COVID. So we'll see those changes when things like that do take place.
Well, all right. You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. And one of the things as you go through retirement, it's going to change. You know, you take a look at the last 20, 25 years. Okay. That's about what a retirement is. What has happened in the last 20, 25 years? Think about it financially. We've had, the subprime mortgage crisis, and we had COVID, and we had the tech wreck. We had all these crazy things happen. Yeah. Inflation went up to 9% and now back down to 3%. Look at what will happen in the next 25 years. That's what you're going to be dealing with when you go through retirement. That stuff's still going to happen. So you're going to need somebody to help you along the way. And that is why Charisse is here. Give her a call. Let's sit down and build that partnership that you're going to need as you go through your retirement years. Here's the number. It's 833-368-3680. Again, 833-368-3680. Online at zinniawealth.com. That's ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. It's basically a no-cost meeting and no obligation meeting to sit down and say, what's on your mind? What are you concerned about? How can we help? 833-368-3680. All right. So if you look at market history, August is not such a great month. It's kind of an up and down month. And then we're starting to get into fall, September, October. There's been some nasty stuff that has happened in the market over the years. And Jamie Dimon, who is the CEO of JP Morgan Chase, said in an interview on CNBC, I don't think I am a buyer at this point. Now, he didn't say that he was a seller, but he thinks that prices are too high right now. So I want to ask you this, Charisse. We're looking at the market all the time. You're looking at the market all the time. There is a time to buy. There is a time to sell. And is there a time to just sit? Is there a time to just I'm just going to watch right now, just kind of cool it? Do you go through those kind of cycles?
I feel like that's a really dumb comment from Jamie Dimon. Think about it. Think of all the times the market hits a new high.
Yeah.
And then it keeps hitting a high. And then there's a 10% correction and it hits a new high. If you listen to Jamie Dimon, you might be missing out. What if it keeps going? What if it goes down 5% and you miss a 5%, then it goes back up 5% and now it's up 10%. So if the market's moving, the market is moving, right? So these big wigs, we think they know what they're talking about. And sometimes just their conversation moves the market and they're doing something totally different. So yeah, the market's up. It's high. And guess what? I think it's going to keep going up.
Okay.
So take his advice or don't take his advice. But I will tell you this. Our clients don't worry about it here because when it comes to buying and selling and sitting, we're doing that because we do active management, right? The last 3 months, we've traded the portfolios 15 times on just one type of portfolio. Another portfolio, we only trade once quarterly. We have the buy and hold portfolios. We take that worry off the plate because our clients are seeing us do this. They're just like, man, you guys are moving and grooving, right? If the markets are being wonky and starting to go down, we're going to take some of those dollars from that higher risk stuff, and we're going to probably put it into cash equivalents or something more of a fixed income strategy and then wait it out and then go back in, right? So it just depends on the type of portfolio and the type of investor you are. But I really think that's a really dumb comment from Jamie Dimon. I hate to go against him because I do like him, but that's nonsensical. He said that before and the market kept going. He said that before and the market kept going and it went down. But then if you follow that noise, you have to be a day trader. You have to be in it all the time because how are you going to make good decisions? So if you're sitting on the sidelines in cash, I'd say buy. Right? The market just had some movements, right? And if it goes up, it goes up. If it goes down, who cares? You know why? Because not all your money should be sitting there. And I say who cares because it's going to go up. I don't project a 30% down crash anytime soon. And anybody else out there that thinks that, come talk to me. I want to know what you know that I don't know. But yes, I know markets have been moving and we're hitting all-time highs and I could be totally wrong, speaking out my you-know-what, and the market starts to go down 20%.
Well, one of the things that you and I have discussed in the past, and we've put commercials out there as well about these kind of things, is having an exit strategy. And I kind of liken it to, you're on the freeway, and all of a sudden you look up ahead, and there's this massive line of cars, and all you see is brake lights, and there is an exit right there. And you go, and you look down at your GPS, and it says, yeah, I can take this exit off, and I can get around this. And that, in a way, is kind of what you do with markets. There are triggering events. There are signs that you kind of pick up on that you watch. And if those start to signal red, now it's the time to kind of enact the exit strategy. So is that built into all the portfolios that you have, even people that don't have a whole lot of market exposure?
Yeah, so they're not built into all portfolios, but I do believe it's important to build it into some of your portfolios. So we have safe money strategies, we have income strategies, and we have growth strategies. On some of the growth, not all the growth strategies, we're going to have an exit strategy built in. And every single one of our clients does have a little piece of that pie. So if you come in with $1 million, you're going to have 8 buckets with us. And one that's trading quarterly, one that's doing day trading, one that has an exit strategy. You're going to have probably 2 or 3 safe money strategies. You're going to have some safety money as well. So a dividend portfolio on top of it. If you want me to sprinkle in a little Bitcoin, but most retirees do not want that, we'll do that, right? And, we want to make sure we're hitting technology with a few of our bucks. And you might also come in here and say, Charisse, you're insane. I don't want to lose another dollar and I just want to preserve it. I got strategies for you. They're also actively managed for the preservation strategies and safe money strategies.
Well, one of the things that I think that most people are really kind of nervous about when they go into retirement, and this is it right here, how much money do I need in that market? And you've said to me many times that someone will come in and they've saved the best that they possibly can. They have $500,000 or less. And then other people will come in and they have $1 million and more. And those are going to be 2 different kind of strategies. One person is going to want to have a lot less risk, a lot more income, and the other person is not maybe needing all the income, but they have a lot more need to grow their money, and that's what they've been doing all along. So, when somebody walks through the door, they're not going to get that same portfolio. If you're seeing your friends retire, your relatives retire, your siblings retire, all that kind, your retirement plan is probably going to be unique to you, isn't it?
Yeah. I mean, I'll give you two different types of strategies. I had somebody come in with $5 million, but between Social Security and pensions with him and his wife, that $150,000 in income, $150,000 in income. So they said, Charisse, put me in your riskiest stuff because I don't care if I lose 50% of that. I went, really? Like that to me bothers me, but hey, that's your prerogative. Because he said, you know why, Charisse? I'm like, tell me why. Because I have the income I need. I'll never draw from this portfolio. Of course, me as a financial planner says, well, if you die, your kids are going to inherit that money and they're going to have to cash it out over the next 12 months. And then depending if it's IRA money or trust money. And I said, so they're going to be inheriting it at a low, right? There wouldn't be enough time for that recovery. That's timing it, right? He's like, oh yeah. But he's like, I'm okay with that. They don't need more than that. And then I have somebody who comes in with, I know, I laugh, and I'll do it, right? Here's your money. You get to decide. I'm just that person, the voice of reason. Then we have somebody who's $500,000 that has Social Security and no pension. We got to make that money work as well. But a lot of times those people, they've done such a good job because they know they saved less that they don't have any debt, right? In between two of their Social Security checks, that's where a lot of the dollars went. They have 50,000 in social and they only need another 25,000. So it just depends on who you are, what you've done, what you saved. And you just got to let us take inventory and get to know you so that we can propose, a plan where you're more confident because we don't want people running out of money. Like I've always said, no, you're not going to run out of money on my watch unless you overspend, right? And we always try to front load things at the same time to try to make it work the best to their ability to enjoy their go-go years.
Yeah, all these years you've been just putting money into a 401k and you know that there's some market exposure there. There's mutual funds and ETFs and all that kind of stuff. But then you get into retirement and somebody talks to you about, oh, we got to, have money in the market and we got to have money in this risk bucket and that risk bucket. And all of a sudden you start, I've never been that person my whole life. Why do I have to be that person now? Well, maybe you don't. Maybe you don't need, 10% growth in the market. Maybe you can do 3 or 4 or 5% growth, and that can be a lot more acceptable to you when it comes to a risk number. We'll talk about that more today. But in the meantime, let's sit down and find out who you are when it comes to retirement. How do you want to use that stock market? Do you want no part of that stock market? Let's find out what's right for you. Here's the number and here's the website to have that conversation. No risk, no obligation to sit down and talk about your retirement. It's 833-368-3680, 833-368-3680, or online, ZinniaWealth.com, ZINNIA Wealth.com. And when you go to the website there, you're going to see a gold box. It says complimentary retirement consultation. When you click on that, that'll get you going. And as a matter of fact, Charisse, there's a lot of people that have been coming to you over the years to get help with retirement planning. And once again, you have made the Inc. 5000 list. Congratulations on that one.
Thank you. 4-time honoree. Do you know how hard it is to get in the fastest growing companies Inc. 5000 list? And there's so much competition. But here was the neat thing that we found out. We were the only wealth management financial firm in North Florida, between Gainesville, Ocala, the Villages, and then there was like 2 in Tampa and 2 in Orlando. That's how hard it is. So that was a really big deal for us, that out of all the companies in this area, like we're the ones who landed in the top 5,000 fastest growing companies. And you know what that tells us? It tells us that what we're doing is proven to keep clients, grow our client platform, and scale and grow, which is incredible. So that means, I feel like what that means is that we're really doing the right thing, because the turnover for most financial advisors is 5 years. You have a financial advisor and then you're looking for another one after 5 years. Like, we don't do that. We're like lifers with our clients, right? I might have had 1 or 2 Z's fall off here and there, but because we're keeping our clients, I think that's a big part of the picture, and people are happy. They like our customer service. We continue to make changes instead of them going and seeking efforts and advice from somewhere else, because you can't get better advice than here, right? Not too many advisors do what we do around the country. And so for our surrounding area, it's just such a huge honor when we make that list. And I'm actually, for the first time, I was invited to their gala and their thought leader forum. And so I'm going to do that. I'm going to be surrounded by other people who are on that list and learn some stuff and just be part of their leadership group. So I'm super excited about that, which is a huge honor.
Well, we've talked about this over the years. As Charisse said, she's on the list 4 times. And when I think about a business and they talk about the fastest growing business, usually when you launch your business, you get off to a slow start and then zoom up like a hockey stick, right? You're zooming up.
Yes.
But then you've been around for, 5, 10, 15, 20 years. And you're still growing at a great rate.
Yes.
So that's really got to say something to you there.
And I can't do it without our team. Like it's all team ready, right? We got a great culture. The staff is just amazing. And I'm so thankful, right? So that I can go to these galas and these leadership forums and grow myself as well. So I got a great team. I love my people.
Well, come on over and find out
and my
what...
clients. Wait a minute. I got to thank my clients. And I got to thank my clients. Thank you all. I'm so selfish. It's all about me and my team. Now I got to thank my clients because I wouldn't make it without you guys as well. So there's so many people surrounding Zinnia that just make all this happen. So thank you to you all.
Well, contact Zinnia Wealth and find out what everybody else seems to be finding out as well, that this is the place to get your retirement help. Again, zinniawealth.com. All right. So one of the things that we do on this show is watch out for things that change perhaps your retirement and financial landscape. And one of the things that has happened is, politically speaking, there's always changes in retirement and things like that. The White House, the Trump administration has decided to kill a subsidy that helped reduce the price of Part D in Medicare. That's the drug plan. So they didn't eliminate it. They just eliminated some of the help. That means the premium could probably go up on Part D for this next year. We don't know how much, but we do know it's going to take effect next year. So this is the time when we start thinking about these things. October, November, December is when you start doing things about this, when you have your Medicare meeting. And Charisse, is this the time to reevaluate it? When we talk about Part D, you've talked about the donut hole and things like that we have to deal with, and they've been trying to fix that. So what are we looking at here, and how would you solve this problem as somebody sits down with you?
Number one, it's a little disappointing because, the government worked really hard to help people through the donut hole where costs are like paying 100% of their drug costs instead of getting the discounts through your drug plan. And so they really did a good job lowering those costs and getting rid of this donut hole issue. But they must have had a math equation that says as soon as that hits, we'll give them 1 year to enjoy it. And then we're going to raise all the premiums. I'm like, they always have a math equation. When I say that they don't know basic economics, they know basic how to screw you. That's all I got to say. But they sure sounded good when they put it together. Okay, but I'm going to be fair. I don't know enough about this. So you guys all know Medicare. I'm chomping at the bit to learn what all the new rules are. All the plans come out in October. And then we'll have more data on, did Humana go from $30 a month to $50 a month? I'll get an average. We'll see where everything lands and we'll do the math. But if that is the case, what you're going to have to do, you're going to have to shop prescription drug plans. There's hundreds of them out there, right? And so you need to make sure this year, if you have a United Healthcare prescription drug plan and you're paying $50, you need to make sure it didn't go to $100. And if it does go to $100, then you need to see, is there another plan that didn't go as high, or can you start shopping for those newer plans that maybe have a lower premium that still cover your drug? So I'm going to be very curious how this all unravels, but we will have more data for you because that adds up year over year. And if it's going to be cut, what's going to happen in the future? It's probably going to keep going up. And are they going to cut other things? So I hate when I hear these cuts. So we'll see what unravels.
Each year at this time, we ask you to kind of look at yourself in the mirror and say, do you know if laws have changed? Do you know if plans have changed? And have you changed? Charisse, that's one of the main things that I look out for each year for everybody. And that is, you've told me that as you get a new diagnosis, whatever your treatment is going to be might not match up with your current Medicare plan. And there might be a better plan for you if you're going through some kind of treatment. So as you change as well, you got to kind of keep up with this, don't you?
You do. And those people who have Medicare Advantage plans, And so that's a Part C. There are usually HMOs and PPOs. You might see those premiums go up because of this new subsidy that's going away. So now you got to be careful. Like, you're on Blue Cross Blue Shield or Humana, you might be going to United Healthcare or Freedom or one of these other ones. So we need to keep an eye out for that as well. So, we help people, we talk them through Medicare and the basics of Medicare and what the differences are between the Advantage plans and Medicare supplements and prescription drugs. So 'tis the season, it's coming up right around the corner, and we'll be ready to rock.
There's a lot of different reasons to go see the team at Zinnia Wealth. If you're just getting started with your retirement planning, maybe you already have another advisor and you hear the show, you hear the podcast, and you go, she's talking about stuff that my person isn't talking about at all. I need a second opinion. Or as laws change, as plans change, as 401ks change, as Medicare changes and Social Security changes, all these things are coming at us. It's another reason to sit down and talk to Charisse. Are they affecting you? Is there a better way? Let's sit down and talk through it. 833-368-3680 or zinniawealth.com. All right, we've talked about it for 13 years, Charisse. That is, what's the number one fear of people going into retirement? Running out of money. That's right. So what's interesting is that we need that income, but 40% of retirees are having trouble spending that income. And 50% of retirees do not have an income plan. So we all know that if you have guaranteed income in retirement, you're probably going to spend it. If you have a 401k that you're peeling money off, you might not spend as much. You might not enjoy yourself as much. So, Charisse, from a percentage standpoint, I'm always looking at this like a pie chart, of all the money that somebody saves, it's $1 million. How much of that money, percentage-wise, is set aside? This is what we're going to use to build you income in retirement. Is there a hard and fast number? I imagine it varies for everybody.
It does vary depending on what you need to live on an annual basis. So if you have $1 million, you need to have a safety bucket with $100,000, most likely, an income bucket with maybe 400 or 500.
Okay.
And let's just say it's 400. So that means you have 100,000 in safety, 400 in income bucket, and then 500 could possibly go in the growth bucket. It just depends how much income we need. So that can change big time in the strategy. So that's just like the first, most important thing when it comes to concept and understanding. That's where we stand, because we know it's in that safety bucket, in that income bucket. Then you have more confidence to put some money in that growth bucket, right? And the biggest fear is running out of money. And the reason is because when the markets crash, people still pull their money out. They still need it. And they watch their accounts go down, 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 down. And they're like, okay, well, it's going to recover like it always has, but it doesn't, because you're pulling money on the way down and you're pulling money out on the way up, and it never recovers. And now you have less assets, and it'll never, ever get back to even. And now you're dealing with half the assets because you're having to pull more money, a higher percentage out of those accounts just to feed yourself, right? And if you dare want to go on a trip, that's going to cost you money. You got to pull money out. So it really hurts you long term. So we want to make sure that income is dialed in. And the income doesn't have to go into these income annuities, Randy. There's a lot of advisors out there selling income annuities. Some of them are really good. Some of them really are not that good. And so for me, when I sit down with clients, I don't do the income annuities because they have fees. And based on how we build out their income plan, a lot of my clients don't need them. Mm-hmm. Some of my advisors have to sprinkle some of them in if we're trying to buy more income and really front load it. So it just really depends. But I like straight growth. I like safety built into growth. And there's so many strategies out there to do it. So if you're sitting with an advisor and you have $1 million and like, let's put $900,000 into this income annuity, is going to guarantee you income for life. Big mistake.
Yeah.
Like there won't be anything left over for beneficiaries. It's not going to keep up with inflation. And then when you need cash flow, you don't have it. You can't touch it. So we're really cautious that we educate people about the good type of annuities out there that build income and the not so good ones out there. So
people come into retirement with all different kinds of assets. Everything you have might be in a 401k. This is my retirement. Okay, that's fantastic. But we got to talk about tax planning. You might come into retirement with a pension, Fantastic. We don't have to talk about as much income planning. Maybe you're a couple that has both worked your entire life. You've got a nice Social Security. It's $5,000, $6,000 a month. Fantastic. That just puts you in a different category from everybody else. You're going to have different needs. Your retirement plan is going to be unique to you. Let's sit down and build it together. Here's the number and the website. You can go to zinniawealth.com, ZINNIA wealth.com, and hit the button there. It says complimentary retirement consultation. That just means a free meeting where we sit down and talk through your questions about retirement and see if there's any gaps there. Are you headed for a tax problem? Do you have an income gap? Let's talk through it and plan through it. 833-368-3680 or again, zinniawealth.com. All right. So Michelle Gass is the CEO for Levi's, and she was on NBC recently, and she was talking about keeping her life and her business on track. I think there's something we can learn from this.
I try to be pretty disciplined. I like to be a planner, but also make room for those spontaneous moments. One of the metaphors that we've embraced in the company is the telescope microscope, that you always have to be looking through the telescope, being clear on your long-range goals, but also tend to, as a retailer, what's happening right here and now in the microscope. So I actually have a little telescope microscope thing on my desk that reminds me to remember that you're constantly toggling between the microscope and telescope.
Love that. Okay. So that it really is kind of a metaphor for retirement planning, Charisse, because when we go in, we're going to look, in the next couple of years, there's your microscope. What's happening on my day-to-day life and what do I want to do in the immediate future? And then I need you to look down the telescope and tell me what I'm in for long-term, 15, 20 years from now. So tell me about where you would put those things. How do you stack that up?
So when it comes to the microscope, we're really going to take a deep dive on what you have saved, what your income is going to be, what your long-term goals are, what your short-term goals are. Do we leave a legacy? Do we have long-term care? And really put that microscope together to make sure we don't miss any of those cells that are part of your retirement plan. So the microscope, I would say, would be the short term of the first 5 years. So what are we going to do the first 5 years of retirement? Do we still need to pay off debt? Or is the debt paid off? Are we going to travel and travel first class or travel coach? So what does that microscope look like in the short run? So we can make sure those dollars are sitting there and ready. So maybe those are the dollars we keep a little bit more safe. Maybe they only average 4 to 6% because not all of our money needs making 10 or 20% when the market goes up. We just want to make sure that that microscope has its eyes on the prize for those first 5 years so that you don't have to worry about where your income is coming. Because when you're worried about where your income is coming based on the market volatility and it's going up and going down, guess what? You're going to spend less during those go-go years, especially the first 5 years. So we just want to see where those dollars go, create a couple of buckets for the first 5 years to 7 years in retirement, to be exact. And then that telescope, that is totally long-term, right? How far out can we see in your future? So we're going to look at the 10-year all the way to the 30-year. Let's say you live 30 years in retirement. What's likely to happen based on what we've seen in the last 30 years? What are the hazards that could arise? What if somebody went into a long-term care facility for 3 years and spent $200,000 a year? Because long-term, that's what it's going to cost, $250,000 a year. And that's $500,000 if you're there for 2 years out of your portfolio. Maybe you had $1 million. And then you die, like that telescope, we're going to really inject a plan that works if that were to happen. Like, do we buy insurance now? Can we self-fund it? Is our pensions going to cover it? So we really have to dial into those types of things. But the investment strategy, if we know what you need to live on for the first 5 to 10 years in retirement, then we kind of know for that investment plan strategy, how to invest the rest of the money. So if you have $1 million and we really want to capture 500,000 for the first 10 years, then the other 500,000 is going to do something totally different. It's going to do all those things that you like doing now in investments without all the worry, in my opinion, because you don't need to touch those dollars till 10 or 15 years down the road. So those dollars can have a higher risk, a higher rate of return if that's what you want.
Seems to me, Charisse, as you talk about some of the people that you've dealt with and worked with in the past, kind of developed partnerships with, this is where you bring some of those people in. These are where the tax people come in. These are where the estate planning people come in and getting the legal documents all set up for the future, what your legacy plan is. And that's going to be different for everybody because I know that there are friends of mine that are going into retirement saying, you know what, I've done all I need to do for my kids. They are set. I'm not worried about, giving them this big 401k at the end of my life. If it happens, fine. But in the meantime, they're fine. Or there's other people that say, I want to make sure that my kids are handled and I want to give money for my grandchildren. I want to put a college fund together for them. Everybody's going to be different on their long-term plans here, as I'm going to spend it or I'm going to save it and I'm going to build a legacy for someone.
Mm-hmm. And you're going to either pass it on taxable to your beneficiaries or tax-free. So that's the second version of our microscope telescope. It's just not about the income and making sure it's there. It's also about the taxes. Like, who's going to pay the big tax bill? Is it going to be you over the 30 years or is it going to be your kids after you've passed, right? Mm-hmm. And so we want to look at that short-term and long-term, what it costs. And that's always ever changing if the government changes something as well. So it's a living, breathing document, the income plan, and then also the tax plan, which is, to me, really, really important. You need to know now while you have time, why things are still good, on, how we want to structure our inheritance in a more tax savvy manner. And or let's say we could work up this tax plan over the next 10 years and you live another 20 years and the rest of your money's tax free. Do you want to see the math? What does that look like? Does that actually help your estate grow? And the answer is yes. Does it help you save in taxes when somebody dies? Absolutely. Sometimes by double. And so we want to measure that. We want to weigh it. And so how can you do that if you're not looking at the microscope and telescope version of how we do things here?
Yeah, it's interesting I think one of the hardest parts of retirement planning is you looking at yourself and you saying, what am I going to spend? How much money am I going to need 10 years from now or 20 years from now? Because if you were to talk to me in the year 2000 and say, what do you think you're going to need in 2025? Well, there was no Netflix. There was, hardly any. There was internet, and there was a computer, but the cell phones weren't the way they are. And all the things that we pay for now didn't even exist, and now we look at them as almost like necessities of life. And I think about my parents, we had a black and white TV and there were no microwaves and there were no cell phones and there were no computers, and all of that stuff is now there for us. And we feel like it's stuff we've got to have. What's it going to be 20 years from now? Charisse, there's
robots. It's robots. You're going to buy a robot. You guys know that every single one of you listening today will have a robot. You're going to say, no way, Charisse, I'm not getting involved in this. You'll have FOMO like we do with everything else, and you'll have a robot. Do you remember those cell phones that were in these big bags that look like purses, guys? You're like, I'm not carrying that thing. Well, guess what? You have a cell phone. So just wait for it. So we need to make sure there's enough money there. Yep. And on top of that, they're like, with all this AI, by the way, in 10 years, we're going to stop aging. I believe that's going to be true. And so I'm trying to preserve my next 10 years so I can freeze what I got. But moral of the story, I'm like on this health kick. I'm like, I got to freeze this because if it takes them 10 years. You guys have watched those movies, right?
I like where I am right now. I can still play paintball.
I know. I'm freezing. I'm like, what can I do to stay right here over the next 10 years? You guys, all kidding aside, not kidding, there's going to be all this stuff and you're going to want all of this stuff, right? Yeah. So we need to have a plan.
There you go.
I think retirement planning is going to change over the next 20 years, I'll be honest with you. And it's hard to project right now. Give me another 5 years. I can get closer to what the plans might really look like.
Well, that's what retirement planning is. It's looking at the now. It's looking at the 10 years from now. It's looking at the 20 and 30 years from now. Let's sit down and have that conversation. No cost or obligation. Let's get the math going on your retirement. 833-368-3680. 833-368-3680. All right, just kind of fun here. One of the things that's happening right now as the kids go back to school is you see all these pictures, and I'm getting them of my grandchildren as well. Mom takes a picture of them, and they've got this board in front of them as they go to their first day of school. Hi, I'm Zoe, and I'm going into my first day of second grade. My teacher is this. My favorite subject is this. I want to be this when I grow up. And then every year you put one of those boards up, and it's kind of fun to watch the progress. So what I thought, Charisse, is what if you did kind of the same thing for your retirees? You're in the meeting, and now we've built the retirement plan, and they got a big smile on their face, and they're going to go out and retire. So you get them outside in front of the Zinnia Wealth sign with a board, and it says, this is my first day of retirement. Okay, so I'm going to have you fill out the board here for your retiree, okay?
Okay.
So my teacher is...
Zinnia Wealth.
There you go. Okay, I knew that was easy.
Okay.
All right. My favorite activity is... is
pickleball and golf.
okay. Very good.
Or, yep.
Or travel. Yeah. My biggest fear is.
The next conversation I have with Team Zinnia, because I didn't spend enough money based on the income plan. And I'm telling you, if there's fear, that's it. We got some explaining to do. We didn't spend our money like they said to do.
Yep.
Oh, yeah. I get that all the time.
My favorite story that Charisse always tells is, don't you come back here until you take that cruise.
I know. I don't think their fears are running out of money, because that's their fear before they walk in the door.
Very good. All right.
We haven't spent our money. I've had these conversations.
All right. And the last one is at the bottom, it says, my goal is.
Okay. My goal, there's a lot that people's goals are, is to travel more, right? That would be one that people say. Another goal people have is to get in better shape and health.
Okay.
Those are the two things. Travel more and get in better shape and health. That's the big goal. And then the third goal, like if somebody's like, I don't do that kind of stuff, is make sure I see my grandkids and do more with my grandkids. That would be their goal. So we're believing what I see a client typically say, right?
I think you need to think about this and put this on Facebook. I think this is a marketing genius right here.
All right, here we go. We're doing it.
Okay.
Oh, I love it.
We're about wrapping up today on Retirement Coffee Talk to sit down with Charisse and talk through your retirement board and what you want to do in retirement. Let's see if we can make that happen. You've done a great job saving your whole life. Let's put that money to work to make that retirement that you want. 833-368-3680, 833-368-3680, or use the website, which is zinniawealth.com, ZINNIA wealth.com. Hit that gold box there and you'll be on your way. Charisse, that is all the time we have on this one. I'll give you the last word.
If you want to spend more in retirement, pay less potentially in taxes, and be more diversified, you're going to want to hear this show. So as usual, live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.